All right, are we ready?
Almost. I am just waiting for that delay on YouTube's end.
Okay.
Okay, you are ready to go.
All right, thank you. Welcome. This is the East Bay Regional Park District Board Finance Committee meeting for August 27th, 2021. And we are meeting virtually once again because of permission to do so. And for those of you who would like to speak on any topic, please contact Caitlin Stone at her Park District address, which would be cstone@ebparks.org. Right, I'd like to begin by taking a roll call. Would someone do that?
I'd be happy to, Chair Lane. Thank you. Why don't we start with you, Chair Lane?
Here.
Thank you. And Director Eccles?
Here.
Thank you. And Director Corbett?
Here.
Thank you all.
All right, thank you. Deborah Alkers is here, who's our AGM of Finance, etc. And I wonder if you want to introduce the staff who is present.
Thank you, Director Lane. Yes, we have our General Manager, Sabrina Landreth, is with us today. We also have Assistant Finance Officer, Deborah Spalding, Assistant Finance Officer, Michelle Strawson O'Hara. We have Capital Projects Manager, Ren Bates from the ASD Division, Kim Balingit, our Accounting Manager, and Talvon Sepan from our Budget Section. And we also have Ruby Tumber representing the Operations Division. Thank you.
All right, thank you. Thank you and welcome to everyone. So our first item on the agenda is an item for recommendation, and it's the June 30th, 2021 investment report and portfolio review.
All right. This is Deborah Spalding, Assistant Finance Officer, and I am sharing my screen now. Can you all see this all right? Yes, okay. So I'm going to start out by briefly walking you through the chart on page 3 of your packet, if you want to follow along. And then I'm going to turn it over to Allison County, who is here from PFM, and PFM is our financial advisors. So I'll start out by talking about our liquidity portfolio. So this on page 3 is at the top section. So the liquidity portfolio are those funds readily convertible into cash. So short-term investments that have right now a very low yield. So looking back at the Q1 market value, you can see we did increase our short-term investments, and that's primarily related to the receipt of property taxes. But I also wanted to point out that yields are remaining very low in our short-term investments. So if I looked back at Q2 last year, we had earned $400,000 on our short-term investments, and this year only $71,000. Looking at our 2 major pooled cash funds, CAMP, which is the California Asset Management Program, the earnings rate right now is 0.05%, and last year at this time it was 0.5%. LAIF earnings are right now at 0.22%, and last year it was 1.2%. So all this is to say that our investment earnings are going to be lower this year than they were in prior years. And we are looking at taking some of these short-term investments and moving them out slightly longer term if it seems to be beneficial. Then I'll briefly touch on the short, mid, and long-term securities. Just the one thing I'll point out here, and the rest is going to be done in much more detail by Allison, is that we've added longer-term maturity securities to the portfolio in an effort to increase yield. So if you look back at the market value at June 30th, I don't know if you can see my cursor, but we had no long-term securities last year at this time, and we slowly have started adding to that longer-term portfolio. So we now have about $3.5 million there. And lastly, just touching on district funds that are held in trust. So those are funds that are only usable, not for district operations, but for particular purposes. So we have our pension trust fund, That's currently almost $11 million. And almost $2 million of that is earnings on the funds that we've put in there. So that pension trust has done very well in the short term, the short time that those funds have been there. We started the trust back in 2017. We will be having PARS, the firm that manages that pension trust for us, come and speak to the Finance Committee next month. So we'll get some more information about the pension trust to the Finance Committee in September. And then also touching on our project funds, we still have about $31 million remaining in our Measure WW bonds. So we continue to plan to issue those bonds. It's looking like it'll be very late in 2021 when we do that. So I'm going to stop sharing here unless anyone has any questions and turn it over to Allison County, who's here from PFM. And she has a very detailed presentation she'll be giving, talking about the current investment environment and strategy in the coming months. So Allison.
Thank you, Deb. Before we turn to that next, could you make some comments about why the pension trust funds did so well?
Yes, I can touch on it briefly. They are invested differently than the district can invest. So that pension trust is invested in like mutual funds, for example, that the Park District can't invest in. And as you probably know, the stock market has done really well over the past last year in particular. But over this time period from 2017, it's been a really good time for the stock market. So earnings have been really strong in that pension trust.
Thank you. Yeah, please proceed, Allison.
Okay, great, thank you. Good afternoon, everybody. Thank you for having me here today to present to you the report for quarter ended June 30th. And I'll just pull up the presentation here. So just pulling up the presentation that is included in your agenda packet. As always, I'll just provide a brief market update. There are also a few slides with some charts on the current economy, but I think I'll cover it all here on this page. And so I'll probably just move past those unless there are questions. But overall, economic conditions during the quarter ended June 30th were characterized by pretty strong growth. We saw cases of COVID-19 drop dramatically during the quarter as vaccines ramped up. And so with that, we really saw economies across the country open up. And when I say economies, really, I mean, stores and restaurants, opening to full capacity, people feeling comfortable going to stores and restaurants and movies. And so we saw very strong growth really during the first 2 quarters of 2021 so far. GDP for the second quarter, the quarter ended June 30, was 6.5% annualized growth, which is the highest it's been, despite that one strong quarter we had, of course, 34% last year. It's growth that's well above what we were seeing pre-pandemic. And really, again, that's been fueled by those caseloads that have fallen. So recently, we've seen cases tick back up a little bit, and so that might cloud the outlook some, and I'll talk about that here toward the end of my presentation. With the strong growth and also with the stimulus that we've seen, inflation has picked up recently. Early in 2021, we started to see signs of inflation expectations picking up, which had an impact on interest rates. Well, during this quarter, we actually saw inflation readings picking up. So CPI was 5.4% for July 31st, year over year. As a reminder, the Fed has a 2% target on inflation, so that is well above the Fed's 2% target. Currently, I would say within the Federal Reserve itself, there's kind of different ideas on what's going to happen with inflation. There are some who describe this inflation as transitory, so they think the elevated inflation will be temporary, that over the next couple of months, by year end, we'll see it start to move lower, and it's just impacted by specific circumstances related to the pandemic. While there are others who think this inflation might stick around longer and that the Fed will need to act. And so this is something we pay very close attention to, what the Fed is thinking, because when I say the Fed will need to act, really that means the Fed will need to raise interest rates. The Fed has held their Fed funds target rate at 0 to 0.25%. They dropped it there in March of 2020 at the onset of the pandemic. And that is why, as Deb was talking, you see those very low interest rates on those short-term accounts like the Camp Pool and Lake, because those funds invest in very short-term securities, and those securities are yielding near zero. Now, if the Fed thinks inflation is going to stay elevated, they'll have to start raising that target rate. And so investors pay very close attention to what the Fed is going to do with that Fed funds target rate. Fed Chair Powell actually spoke today at a meeting where he talked about inflation, and it is still of his opinion that the elevated inflation will be temporary. However, he did say that the Federal Reserve is going to start tapering their asset purchases. In addition to dropping interest rates to zero back in March, the Fed began buying longer-term treasuries and agency mortgage-backed securities to lower longer-term interest rates, all with the intent to encourage borrowing, encourage spending, prevent a recession. And it's been very effective. But the Fed thinks they can now start to kind of slow down those purchases. They're purchasing $120 billion a month. So we'll likely see them start to pull back that measure over the next few months. However, Fed Chair Powell said he thinks it'll still be some time before they start raising that target rate. And again, that rate, what the Fed sets that rate at, really impacts the interest rates on the securities that we buy for the district's portfolio. And so that's why it's pretty relevant to the portfolio. In terms of interest rates for the quarter, I'll actually just move ahead a couple slides here. On page 9 of the agenda packet, showing the US Treasury yield curve at 2 points in time. That light blue line was March 31st, so the start of the quarter. That solid, or the darker blue line, June 30. And then we are showing 3 months out to 30 years. So as Deb also mentioned, we do hold some securities with maturities beyond 5 years. It's a fairly small allocation to the portfolio. The portfolio is managed according to a 1 to 3 year strategy. So we're still, a bulk of the securities are in that 0 to 5 year area, but moving out slightly further with some funds. As you can see, the further you go out, the higher interest rates you can receive. But so over the quarter, we saw longer term rates beyond 5 years move down slightly. As for various factors, it's kind of counterintuitive to that inflation story I just told you. When inflation picks up, you typically see longer term interest rates move higher. But right now, I think it seems like the market is still on board with that. Maybe inflation is temporary and then it's going to move back down closer to 2%. Also with the Delta variant and the increasing cases, there are some concerns about growth going forward, and that always pushes investors into treasuries. And then there's still a lot of foreign demand for US treasuries, as the interest rates that US treasuries offer are quite higher than alternatives. Focusing on the area of the yield curve where we invest most of the district's funds, that 0 to 5 year area, you can see interest rates held fairly steady over the quarter. They did pick up a little bit in that about 1 to 3 year area of the yield curve, which we like to see. Again, that's where we're buying securities, so any move higher is great. It does have a negative impact on market values, so you do see unrealized losses when rates move higher. But all in all, I think that increase is good for future purchases. That said, although there was an increase, rates are still very, very low. The 2 year treasury as of quarter end was 0.25%. So still definitely managing the portfolio in a challenging, very low interest rate environment. So I'll move to the portfolio section now, unless there are any questions on what I just spoke about or anything I didn't speak about that you'd like me to answer now.
Are there any questions? Okay, please proceed.
All right. So in the portfolio, in terms of portfolio strategy, this was a quarter where diversification really benefited the portfolio performance. So diversification away from treasuries into other sectors, which I'll talk about more on the next page, provided higher returns than treasuries. That said, all returns were very low for the quarter. A combination of low interest rates and that slight upward movement in yields resulted in very low performance for the benchmark, for the portfolio across all sectors. But the portfolio, as we will see, did outperform the benchmark, again, because of that diversification. In terms of where we're finding value in the market, value is tough to find outside of treasuries because of those narrow yield spreads. Federal agencies, there was no purchases in the federal agency sector during the quarter. In most cases, we've seen treasuries yield as much as federal agencies, so there's no yield advantage to buying a federal agency. So we'll definitely purchase a treasury, the safest investment over an agency. And then getting into the credit sectors, high quality corporate notes and high quality asset-backed securities. Again, we do really seek out opportunities there because they do offer a yield advantage, although it's less than it used to be, and they historically provide good, strong returns. We're being very selective because that value is limited right now. But during the quarter, we did selectively purchase from both of those sectors. And then finally, just the municipal sector we pointed out, we did not add any new municipals during the quarter, but as we talked about a few quarters ago, we added a fair amount in 2020, and those holdings have performed very well for the district's portfolio over the past couple of quarters. On page 13, I'll just briefly, so here just showing the portfolio by sector allocation, that 138 million invested in the portfolio. And then we do also show you the CAMP balance here as the CAMP pool, again, similar to LAIF and overnight account liquidity is managed by PFM. So a total of about $212 million. And really just focusing here that you are in compliance with the investment policy. So here on the next page, a snapshot of the PFM managed funds. I'll just point out a few things. So the yield at cost on the portfolio, which would be essentially the earnings rate on the portfolio on June 30th, was 0.99%. So it is a yield if you compare, if you look at the quarters from the past year, you do see that yield at cost, the earnings rate, continue to move lower. As securities in the portfolio, securities that we purchased several years ago are maturing or nearing maturity and being sold, we are reinvesting in this very low interest rate environment. But you can also see the yield at cost of a 0.99% is well above that yield at market, kind of showing you what current market yields are. And it's well above those overnight accounts, the LAIF account, the CAMP account. And so it does show you the benefit of having some of your funds into this longer term portfolio. It's also the reason, as Deb mentioned, the district pays very close attention to your liquidity needs. And if there are opportunities to move some of that liquid funds that aren't needed to make payments into the portfolio to, again, over the long term, produce higher returns. So the district has had a very good strategy of managing those two different portions of money. The portfolio is very high credit quality, a AA, average rating of AA, all in compliance with code and your policy. And then again, diversified by the different sectors up there in the pie chart. Page 15 has the performance of the portfolio. So as a reminder, we show performance on a total return basis. So it takes into account realized earnings, interest, realized gains on sales, and also unrealized gains or losses. And so for the current quarter, the portfolio had an unannualized return of 5 basis points, 0.05%. As I mentioned, a pretty low return. But you did outperform your benchmark. The benchmark, which is the 1 to 3 year US Treasury index, had actually a negative return for the quarter, meaning those unrealized losses were greater than the realized earnings. And so that's where I mentioned you can see the benefit of diversification. And all Treasury portfolio, couldn't eke out a positive return for the quarter while having those higher yielding securities. That diversification helped the portfolio. Granted, not by a lot for the quarter, and again, really due to those very narrow spreads, very low rates. But for the past year, again, not a very high return because interest rates have been low for over a year now. But again, very, very good outperformance of the benchmark. And, again, that's why you have a benchmark, so you can see how the market is doing, and your portfolio is doing very well relative to the market. And since inception as well, since inception of the portfolio, earning a 1.45% per year on average, outperforming the benchmark by 0.26%, a good spread over the benchmark. And then just the outlook, the economic outlook, I'd say from when these bullet points were written back in early July till now, it's maybe changed a little bit. It's not quite so rosy. We do expect the economic expansion to continue. Expectations for GDP for 2021 as a whole are 6% or even slightly higher. So that's very good growth in the US, well above what we'd seen pre-pandemic. Again, that's really being driven by the consumer, by all of us, wanting to get back out there. And now that we feel more comfortable spending money. But again, there's some uncertainty with the increasing cases right now. And then I already mentioned inflation and the Fed, and based on Chair Powell's comments today, it looks like it'll be sometime, at least into 2022, likely late 2022, before the Fed even considers raising those interest rates, meaning we're going to look at low yields here for the next several quarters. In terms of sectors, it's very similar to what we saw last quarter. Spreads are very narrow, limited opportunities outside of treasuries, but we think diversification is very important, and so we continue to look to selectively add from the permitted investments. I'll move to the next section, a few pages on the ESG score of the portfolio. So just on page 18, briefly just showing that the ESG rated securities make up about half of the portfolio as of quarter end. US Treasuries and municipals obligations do not have ESG ratings, so just showing you what we're looking at when we talk about the score. As of June 30, the portfolio had an ESG risk rating of 23, which is in the medium range, and I'll talk more about that in the next page. But just here, focusing on the current quarter and showing you what comprises that score of the ES and G environmental risk, making up a pretty small piece of that overall rating, adding just 2 points, if you will, to the score. The social risk coming in with almost 12, and then governments at 9. And then you can see in the chart there how those different pieces are made up among the sectors. And I won't be covering it today, but back further in the report, we do contain a number of pages that provide a lot of detail on what all of these different categories mean. And so it can be referenced for additional information. So now looking at the score of the portfolio a little closer. So I mentioned the score for June 30 was 23, overall ESG risk rating of 23, improving slightly from last quarter at 23.6. The change as a result of some modest changes to the issuer ratings, also some portfolio activity that happened over the quarter. And you can see, looking at the different buckets, going from negligible to severe. Of course, the district holds no securities that have a rating in that severe category, a limited amount in that high category, with the bulk of it in the medium. You can see the negligible and low both increased a little bit quarter over quarter. As we know, we continue to really factor in the ESG risk rating as we make trades in the portfolio. The portfolio's exposure score also improved slightly over the quarter, as a lower score decreases ESG risk. Exposure refers to the potential universe of ESG related risk that a specific issuer has, largely based on their industry. So something maybe they can't control, like an oil and gas company would just in the nature of its business have a lot more exposure than a financial company. And so
Allison, are you still there?
Looks like we lost Allison's audio. Maybe, are you back, Allison? Can you try and talk again? Well, looks like she's having some technical difficulties. I know she's running the slides too. I don't know if she can hear us.
I can stop her sharing and then, oh, there we go, someone else did it.
Bring it up.
Hi, can you hear?
Yes.
Sorry,
Yes.
I
Hello,
just
Allison.
thought it's like my internet connection on screen. But I'll keep going. Should I keep going?
Sure. We took your share down. Do you want to share your screen
Yeah, I
again?
can put it back up.
Great. We're glad
I'm
you're.
just about done.
We might need someone else to do the slides because I think she's had an audio issue.
Yeah, she is.
Yeah.
So Deb, I think she was almost
I
done.
think she is almost done.
Is there,
I can pull up the presentation.
hey, Allison, do you want to go to the next slide?
One of us could request control too.
Yeah, that's actually what I meant. If somebody else could do the slides and then she could just be on audio, it might work.
Yeah, I'll call in so I don't get mixed up. But I was done. I was just going to finish up by saying it's been a year since we started the ESG approach to the portfolio. Over that time, it's remained in the median range, but hasn't improved.
Yes. Well, Allison, thank you so much. I think we did get through. There was maybe, I think that was maybe your last slide talking about our environmental, social, and governance risk scoring. And as she was mentioning, we started this well over a year ago. And so now we have some data to look back to see our goal is to just continually improve our score, which means to make it lower. And as we buy and sell additional securities, we're keeping in mind the ESG ratings for each of the companies, along with all of the other criteria that we use related to credit risk and all the other reviews that we work with our investment advisors on. So Deb, was there anything you wanted to add? I know the report does include quite a bit of ESG information, and if there's any questions that the board has, or if you'd like to talk about any of the details, we're happy to do that.
Yeah, I did bring up the presentation so I could share that if you want me to do it.
Okay, Elizabeth, you had a.
Yeah, I had a question actually on the diversification section. So I was just interested to know, is there even greater opportunity to diversify further, especially given this time of, really very low rates? I saw Deb shaking her head. So I know we're limited by our investment policy, but can you just explain the parameters around that?
Yeah, so our investment policy is based on what the California Government Code allows. So we take the government code, which was informed heavily by, I think back in like the 1980s, there was some massive bankruptcy in Southern California. And so after that happened, the state said, you cannot invest in anything that's risky because the local governments can't afford to lose significant parts of their investments. So everything we invest in has to be really sound, like A-rated, only certain types of investments are allowed. So that's why you don't see any stocks, for example, in the portfolio. It's only like heavily treasuries and other things that have very high ratings. So it's really state code, but then our own district investment policy gives a little bit more, always has to be within the state code guidelines.
Well, I meant really diversifying into longer term securities of highly rated securities. So are we limited in that as well?
We did. So a few years back, we actually amended our code to allow ourselves to invest longer than 5 years. So state code says that that's only permissible if the local government gives themselves that explicit permissions. We have that now. Up until this year, PFM has not said that that would be beneficial. So this year, this is the first time that they've said that that would actually benefit us. I do think we do have some funds that are permanent funds where we can't use the principal, we can only spend the interest. That's a small amount of the district's total assets. But I do think that we could do some longer term investing to try to align better with what our permanent funds are. But up until now, PFM hasn't advised us to do that. They haven't felt like the time was right.
Okay, thank you. So maybe can, wait, did we lose her altogether?
She was going to try and call in.
Oh, okay. Okay.
But yeah, she doesn't seem to be back yet.
Yeah,
Okay, are there some other questions? Something on ESG? I see they have a list of the holdings as of June, which I always think is very interesting. Okay, any other questions on this or comments? Yeah,
I
Elizabeth.
just had a follow-up question, when she comes back on. I was just interested to know, like, at what point would they recommend that we invest in more sort of 5-year highly rated securities? I just wanted to understand that dynamic a little bit better if she comes back on. So
Great. We could take the recommendation to move the item to,
sure, yeah.
to get that done with while we're waiting for her.
Okay, so have we lost Allison?
See her coming back, but she did say she was going to try to call.
Oh,
Yeah, it looks like we lost her.
Well, I'm happy to go ahead and move the recommendation with the report.
second. Okay, so there's been a motion and a second, and with no more questions at this time, although we might have something if Allison appears. Caitlin, would you call the roll, please?
I'm happy to. Let's start with Director Eccles.
Aye.
Thank you. And Director Corbett.
Aye.
Thank you as well. And Chair Lane.
Aye.
Thank you all.
All right, thank you very much. And as we indicated earlier, we've altered the agenda to move item 4 to be looked at now, and that is second quarter 2021 general fund and other governmental funds.
Hi, good afternoon. Michelle Strawson O'Hara, Assistant Finance Officer. So today I'm presenting the second quarter 2021 General Fund and Other Governmental Funds Financial Report. We will start with an overview of the General Fund revenue and expenditures for the first half of 2021. You can see that the actual revenues through June 30th were $82.9 million, or 47.6% of budget, which is as expected for this point in the year. Revenues are approximately $4 million higher than prior year, primarily due to an increase in property tax revenues. Actual expenditures of $92 million were 46.7% of budget and $5.8 million greater than prior year due to increases in salaries and benefits and transfers out. If we drill down on the general fund, which is found on attachment A of the report, we can see the details of the general fund revenue and expenditures by category and also by division. You'll see at the bottom of the page where there are variances against budget of greater than or less than 10%. There's notes to explain those variances. And you'll see that the charges for services revenue of $3.8 million year to date are at 46.9% of budget, which is as expected as summer programming is underway. As a reminder, the 2021 charges for services were budgeted assuming most amenities and services are offered, but at reduced capacities. For example, the budget included a 50% reduction in program fees, camping, and swimming facilities. The most significant variances in expenditures relate to unexpended supplies, services, and capital outlay, which are on track compared to budget when encumbrances are included. And as a reminder, the district uses encumbrances to reserve or set aside budgeted funds to ensure that actual expenditures do not exceed the available budget. Attachment B of the report summarizes all other funds, special revenue funds, which include our Measure CC, Measure FF, lighting and landscaping districts and zone of benefits, our project funds, debt service funds, and our internal service funds, which pay for the district-wide costs of workers' compensation, general liability insurance, major infrastructure and equipment, as well as employee benefit claims. So that concludes my presentation. Does anyone have any questions?
Are there any questions or comments? Director Corbett, and then Deborah.
Very much. Can you just give us a little more details about the supplies and services numbers being down? I'm assuming it's COVID related.
Yeah, we actually do expect them to be within 10% of budget by the end of the year. They're currently down because we haven't actually expended them, but we have encumbrances set up for them. And when we consider the encumbrances, they're actually within budget.
And I also just wanted to note, it's good to see the board of directors is not spending much money. We're only at 14.1%. So. Thank you.
Just, we're just frugal in every way, right?
Yes, we are.
AGM Offer, did you have a comment?
Sure. I did just want to comment on Director Corbett's question. And remember, we have our summer focus where really the majority, a lot of our supplies and services are purchased and expended during that time period. And the actual expenditures are really only reported when we pay the bills, which, is about 2 months after we make the orders. So when Michelle speaks about encumbrances, those are really saying we've made the order for these things, but they maybe haven't been delivered or paid for. And so that's why it's important for us to look at the encumbrances to say we're on track. And I do appreciate this report because it does show how we're tracking with the prior year. And in a normal year, we track pretty well. When you're looking back at the revenue section, we did talk a little bit about charges for services, and you can see in the prior year, we only had about 1.8 million in charges for services, whereas this year we do have 3.8 million, showing that we are open and doing things, even though the overall budget is, about $1 million less than what it would have been pre-COVID. So that's all I wanted to comment on.
Okay, thank you. I like the comparisons too. It's very helpful. Any other questions or comments? Then I'd entertain a motion.
I'll move it.
Been moved
Second.
and seconded. Caitlin, would you take a roll for this item, please?
Absolutely. And that was Director Corbett who moved and Director Eccles who seconded, correct?
Yes.
Great. Thank you. Just checking my notes here. All right. Why don't we start with Director Eccles?
Aye.
Thank you. And Director Corbett?
Aye.
Thank you again. And finally, Chair Lane.
Aye.
Thank you.
All right, thank you very much. Turning to our next item, we're looking at job order contracting program.
Yes, we have a team of staff from Acquisition, Stewardship, and Design, and I believe Ren Bates is presenting, or Lisa Gorgian.
Good morning, or good afternoon. I'm going to just give a quick introduction. Thank you. Good afternoon, directors, and thank you, Deborah. Lisa Gorgian, Chief of Design and Construction. So I just Again, wanted to remind everyone, this item is a regularly scheduled quarterly update on the JOC contracts that are overseen by the Design and Construction Department. So before I turn it over to Ren Bates, Capital Program Manager, I did want to share that we are in the process of working with David Sumner, the district's audit manager, to verify the accuracy of a sample of the items in the construction task catalog from the previous JOC contracts, and that's in accordance with the JOC policy. So we're really excited. This is important work, and we look forward to bringing the findings to this committee later this fall. So just a quick update on that. So with that, I'll turn it over to Ren, unless there's questions.
Thank you, Lisa. Ren Bates, Capital Program Manager. I'm here to provide an update on our current job order contracting program. In your staff report, we provided this list to you. We are sort of in an interstitial period where we're in administrative we're just doing paperwork basically. So in May, the board awarded the authorized award of 8 contracts. That includes 3A, which are general engineering, do infrastructure projects, 3B, which is building, and they do sort of HVAC, building work as that implies, and then 2A licenses for just paving so that they can support our paving program. With that, we executed all those contracts since that authorization of award, and we've begun pricing. So we're now pricing the current 10 projects that are in front of you. Normally I have pictures of projects that are completed and or in process, but right now we're still just doing paperwork, so I don't have any really good pictures to show. To note also, we also typically have an over of 1 or 2 projects or a couple projects from the previous job order contracting round, and that's the case here. I would like to note that the staff report has 2 of those projects, and I was incorrect when I did that. The Tilden project has been completed. So the only outstanding job order we have from the last round is Contra Loma, and that's an improved facilities project. So with that, I will show some pictures of what we're doing out there. This is a project that we are replacing all of the existing chemical toilets. As you can see here in this slide, these are not really well sited, so we're going to improve the location of those. In addition to that, we're going to improve ADA access to the fishing piers that are out there. There's one beyond here that will make a path from a parking spot just off screen on this photo. We'll redo this picnic area to be an ADA site and provide a path of travel, ADA path of travel to the fishing docks. So again, this is on the last round, but we're working on this one to close it out, and I'll go back to the list just so you can see the 10 projects that we're currently pricing. And when we come back to you next time for our update, in addition to the audit, we'll hopefully have pictures, and some of these projects might be well underway or completed. With that, as a reminder, this is just an informational item, no actions required, but I'm happy to field any questions at this time.
Well, I had a question about the second paragraph. We talked about we'd awarded these 8, and was the 1.5 million job order contract just address the range for each of these projects? Is that what that means?
So the one, yeah, it's a great question, Director Lane. The 1.5 is the limit or the not to exceed amount for the contract. So no money's encumbered with these contracts. The money for that happens comes out of project funding. And so what that gives us is a $1.5 million in capacity to price out and do projects that are repetitive, and or rest. Sorry, my brain is not working right now. Anyway, work that is
renovation work.
Renovation. Thank you, Lisa. Renovation and repairs. It's right. Yeah. And I'm trying to make this brief since you guys had a late meeting last night. Anyway, so that gives us a capacity, and we don't use that money. And we found in our previous rounds, we did 1 million. Basically, public contracting code allows job order contracting up to a limit, which is well in excess of what the district does. And we've done 1 million as capacity in our first few rounds. And we found that to accommodate emergency work and or just the amount of work that we do, we've increased that to 1.5. Hopefully that answered your question and wasn't too much.
Well, that's helpful because, here we are, we look at the list and it's all TBD, there's no
Yes.
figures, but you're pricing it now.
Yes, and typically in terms of that, what we've provided to the finance committee is the price that's been as we report, we're reporting on what the final cost is and what the consultant cost is, and we don't have that yet. But to that end, we do engineers estimates, so we compare what prices against. So we validate, but we don't put that estimate into the finance committee because it's not money spent, and we want to just report what money is spent as a part of the job order contract program.
Okay, so you are showing the Lake Anza spillway gate, and I have a question on that because we do have some figures. So the Gordian Group administrative cost, is that usually what the percentage is of the project?
Yes, so the Gordian Group fees are 5% of the
Okay.
total construction cost. So basically they get 5% of the finalized cost of the job order. So, and that includes their work prior to, in other words, they don't get any payment for helping us set up our construction task catalog, going out to bid, helping us run our pre-bid meetings. They only get compensated for their work once we initialize and finalize a job order and issue an NTP for a final amount. And then their fees are based on 5% of that value.
Okay, thank you. Are there any questions from people? Okay, Director Corbett, you're on mute.
Thank you. Ren, just a general question. When we set up these project lists, how are they prioritized to hit this list?
It's a good question. So, Lisa, do you want to take that?
Ren, why don't you start and then I'll add on.
Sure. So when we approach, or as we approach the end of our job order contracting round and we reach capacity and term limits on our previous round, we reach out to all those departments that use the job order contracting and ask what projects are viable or qualify via our policy. So again, renovation, repetitive work. And then we bring that list and that includes paving, finance management services, operations, deco, and to prioritize, then it's up to the chiefs to then vet that list and then provide it to us. And then I'll turn it over to Lisa now to continue.
Yeah, so just, I think also as a reminder, because these are maintenance projects, many of them actually come to us through, in working with MAST, where repair projects come through their work order system, which is the famous system, and design and construction, financial management services, so Jeff Rasmussen, they also do repair projects, and then Robert Kennedy, previously it was Kelly Barrington, will often meet and review the projects that have been identified to determine if they're going to be too big. So usually if they're $100,000 or more, they'll come to design and construction because that's when they become capitalized. And that's what we do. We do capital projects. And so usually the projects that we're working on for these, they're coming to us through a system. And as Ren then said, they're coming to us because they've been identified because they're health, safety, welfare items. They'll come to us. We then bring that list to the general managers, to our leadership, and then they get elevated to identify as part of the budget process. So we came to you, these projects were then included in the mid-year budget to fund them. Actually, these projects came to you before, many of them came to you before in May as a board item to transfer and appropriate the funds into these projects. So ultimately they come up through the leadership to be identified and prioritized and then come to you. We are trying to, as Ren said, really be proactive in our planning. And so while we're constantly having projects come to design and construction through a work order system, we also are trying to look ahead and understand what's the work ahead that needs to be done so that we can review it as part of the budget process. as well to kind of have a little bit more certainty about the work ahead and understand what the board's priorities are in terms of moving work forward.
If I can add one, if I may add just one note to that, the other thing to tie your question, Director Corbett, with Director Lanes, is that we have 1.5 million capacity so that we can accommodate any emergency projects that come up too. So in our last rounds, for instance, we did the waterproofing at Contra Loma. And so it's a combination of prioritizing work that has been in the queue for a while and it meets over $50,000 and meets all the requirements that the policy lays out. But it also, back to Director Lane's question, is that we have capacity to address emergency projects as they arise, because this allows us to do our procurement and contracting line up a little bit faster in terms of our process.
Thank you. And then I just have a quick question, more specifically, when I see the Monarch Habitat project, I don't necessarily think of it as a capital project, but I was just wondering what, what structure pieces might go with that, or.
So that's a great question. And that's where the district has used their job order contracting previously to do tree removal and other vegetation removal. We've used it with our fire fuels management in the past. And so that's how this one falls under it, is that we're with the object of this is to remove certain trees within the eucalyptus grove there as part in conjunction with operations and stewardship to open up and create better wildlife habitat there. So there's no structure there, but based on precedent of how we've used the program in the past, vegetation removal seems to work because it's a repetitive process that we can then use. And this project is such that it's typically, as I understand it, staff would run projects like this, but because of the size of this project and the amount and dollar value of it, we approved it to be run through the job order contracting.
Okay, thank you very much.
Okay, interesting question. Okay, so Ellen or Elizabeth, do you have anything you want to add or ask? Okay. All right, so thank you very much. I appreciate knowing that this quarterly report's going to come in for us to look at, and always interesting projects. And we do like to see before and after pictures when you come back.
Yes, I will make sure we have some of those.
Yeah.
Thanks. And field trips too.
And field trips. Yes. All right, so our next item is the 2021-2022 tax levy for our general obligation bonds and debt service.
All right, this is Deborah Spalding, Assistant Finance Officer again. And can you guys see my screen okay? Yeah, all right, so this is the 21-22 tax levy for general obligation bonds, debt service, and then a brief update on assessed valuation. So you may recall that at the last board meeting on August 10th, the board approved a resolution that allowed us to create this tax levy. But at the time, we did not have the assessed value information from the two counties. So we always get the permission from the board of directors. And then once we have the information, we bring it to the finance committee to tell you what that levy is going to be. So this year it'll be $2 per 100,000 of assessed valuation in both Alameda and Contra Costa County. Last year, the levy was $1.40, so it's a little bit higher this year. And the Park District continues to maintain its tax levy below $10 per 100,000 of assessed valuation, which was what was promised to voters when Measure WW and before that Measure AA was passed. So here's how that plays out for the average households. I looked up what the Zillow median home value is in Alameda County. So it's $1.1 million in Alameda County. So at that 0.002% levy, that comes out to be $22.42 that they'll pay in Alameda County. And in Contra Costa County, home values are a little bit lower. So that average home would pay $18.12. And then lastly, just briefly, and we have a whole table in the packet that gets into this in more detail, but assessed value information for Alameda County, it's up 4.77%. from the prior year. Contra Costa County's assessed value is up 3.44% from the prior year. So we have for next year, for 2022, we're starting to think about our budget, and we have the information for the first half of the year. And hopefully today we'll be receiving Beacon Economics 5-year projection, and then we'll have their projection for what assessed value will be for the second half of 2022. So we are going to bring that report back to the Finance Committee at the September meeting, and we'll use the Beacon reports plus the known AV from the counties to develop the 22 budgets. So that's all I have for the presentation. This is an informational report, but I'm happy to take questions.
Okay, Deborah?
I just wanted to comment on the two components of what we're talking about. One is the actual debt service that's due, right? So we issue Measure WW bonds based on the voter approval, and we have historically issued about $80 million every 4 to 5 years, sometimes a little longer if we're not spending down those funds. And then the interest and principal that's due on those general obligation bonds is what we're paying with this tax levy. So we are authorized by the voters to add this additional tax levy in order to pay the amount that's due on the debt service. And that, along with the variable of the assessed valuation, is why it changes from year to year. And we will be coming back to you later this year to talk about issuing our next round of WW bonds. It's kind of in the schedule to bring that forward at the end of the year, which would probably be the November Finance Committee. We're looking at how much we've spent down and what the market says. We'll be meeting with our financial advisors, but we're starting to do that work now because we know that about every 4 to 5 years, we issue another set of bonds, and we will be looking at issuing part of that as green bonds. So just wanted to give you a heads up.
Okay, I have a question on the table. Page 75, you have Alameda County 1 and Alameda County 2. Is that because WW is not part of the Livermore area?
Yes, that's correct. So they break it up
Okay.
in chunks for us.
Okay. Okay, any comments or questions from committee members? Okay, anything else people want to add?
Actually, I have received an email back from Allison, who was not able to rejoin. She's still having internet connections, but I just wanted to follow up on Director Eccles' question from the first item. So Allison said that the PFM has been managing to the 1 to 3 year benchmark that they've established. And if the district's interested in extending the duration of the portfolio, then we would want to look at that benchmark also. And so that's a discussion I think we'll have with Allison and Monique and PFM. And so we can bring that back to you at the next quarterly update.
Great, thank you.
All right, so then now we are ready to entertain public comments. Are there any, has anyone contacted us to speak?
There are no public comments, Chairlane.
All right. And then committee comments. Anything committee members would like to comment on? Okay, I see our next meeting is September 24th. And I don't have any comments.
Great.
So with that, I'll thank everybody for their information and for the materials, and Caitlin for taking the role, and we're adjourned.
Thank you, Director Lane.
Okay.
Thank you, Director.
Thank you,
Thank
Director
you,
Lane.
everybody.